Now, back in late February, on the 25th, in fact, the largest listed media firm in Kenya's stock market announced its intent to buy back 10% of its outstanding shares. Now, the proposal, to be clear, is yet to get regulatory approval. But if it does, this will be the first share buyback deal to be executed at the Nairobi Securities Exchange. Now, like other media firms pretty much across the world, Nation Media Group's revenues have been decimated by consumers switching to consumption of content online and the cannibalization of ad revenues by tech giants like Google and Facebook as well. And that's the context for this 5-year decline in its share price and its general underperformance vis-a-vis the NSE 20. Since the announcement, the firm's share price has risen by nearly 90%. That's in contrast to the near 60% decline in the firm's market cap in 2020. So the media firm's revenues have fallen by a third since they peaked in 2013. It's in the middle of an ambitious revamp of its product channels to make subscription revenue a partial or full replacement for its decline in print revenue. But at this time, is this the best possible use of limited capital? That's a question I put to Mbithe Muema. Before becoming the CEO of the Infallible Group, she spent 14 years in investment banking.
Look at their net asset value. That's the shareholder equity that this company has. It's sitting on slightly above 7 billion. And at the time before this announcement was made, the company was trading at near half of the value that the market was actually pricing it at. So even without looking at the assets and the capacity of the assets and the element of them turning over these assets and amending their current business cycle and their business model, already you're saying if you were to strip this company, if you were to take the shareholder funds, and if you were to liquidate, effectively you'd get nearly double than you would get if you're to sell all the shares on the stock market. So I think it's a conversation of you have 2.8 billion. If you spend 400 million, 500 million, give or take, depending on what price point they'll actually get their approvals, it might not be the best use of capital, but in the bigger scheme of things, you're using 400 million of about 2.8 billion. It doesn't necessarily dent what you want to do. It actually just says management has decided to follow this particular route. It could not be the best, but they have the ability and the wherewithal to be able to do it. So for them, it's a matter of it making sense to them as opposed to trying to see how else then do you deploy capital. And they'll still have a little bit more capital to deploy thereafter, just largely based on their cash positioning.
Indeed. Nation Media Group is a bit of an outlier when it comes to this specific conversation. Yes, they're the first to actually pull this off. But looking at the broad spectrum of all the companies listed on the NSE, are there others for whom a share buyback makes excellent sense? I mean, Centum, Dr. James Maury and his team have been talking about doing a share buyback for a long period of time, but they've never really gotten around to it yet.
Actually, I mean, when you bring up Centum, now I'm looking at Nation Media and I'm already looking at Centum, and my appetite is just getting wetter by the minute, because Centum has always said that its net asset value is not reflected. It's unfortunate for Centum because NSC is highly traded by institutional investors, fund managers, who more or less do a similar business to Centum, not by virtue of the assets, but by virtue of the services they provide. They are asset managers. So what tends to happen with a company like Centum, whether it's here or in Johannesburg, it always trades at a discount to its book value, just because people are saying, what is it that you are doing with the assets that you have? So for Centum, this certainly makes sense. The question is, when will it happen? And my read through is to say, if Nation Media has gone ahead with it, and as you have rightly put, was this the best allocation of capital? That's a decision that management has made. Then the next read through is to say, Centum trading at between 17 and 18. It's only a matter of time before they possibly come back and buy back their shares. And the question is, what will they be buying it back at? And for the longest, it's always traded at about 60% of its book value, which is about 40-50% discount to the market price. So there could also be another opportunity there. But the trick is, Ramah, you cannot be able to dictate when management will make that decision. You can buy it and hold patiently till they make that decision.
Indeed, being essentially a value investor there. One last question for you. So NMG didn't announce an interim dividend when they announced the half-year numbers. But what's the tax play here? Because looking at the way the tax treatment essentially in this particular instance, buybacks would essentially trigger capital gains at, you'd have to pay CGT at around 5%. Then there's stamp duty if you're the one who's selling off those particular shares. Is there a tax play to this particular deal?
I'm not a tax expert, so I might not be the best place to answer that, but I'd probably want to throw in a different angle and say, over and above focusing on the tax or the rationale from the company, I think there's also a wider question that asks, is the NSC then a forum for actually accessing capital or building wealth? Because if you are seeing a situation where companies, starting with NMG, are finding it better to deploy capital to buy back their stock, then there's also an element of questioning the objectivity and the essence and the value add of the Nairobi Securities Exchange as a conduit for efficient capital allocation in this country. So I think over and above just trying to understand what the rationale is, there's also an element of what is happening at the NSC, and is it in practice a space where you can actually raise capital? Is it an efficient space that is able to allocate that capital? Does it reflect the true value of the companies? Or could this particular trend that we're seeing with NMG be the particular trend that will be a read through for other companies? And I think the second point, Ram, also to just to look at this is to extend this conversation and say, fine, now it's a 10% buyback. Could then this be a route to a delisting? Because it could easily be a route to a delisting where the company says, maybe the NSE does not reflect our value. Maybe the NSE doesn't add value to our company.